Tēnā koutou katoa. Good morning, everyone, and welcome to our first results announcement as Manawa Energy. My name is David Prentice. I'm Chief Executive of Manawa, and to my left, your right, is Phil Wiltshire, who is GM Corporate Services. So today, you'll hear from both myself and Phil. We'll step through the presentation that hopefully most of you online will already have had a chance to have a quick look at, which we uploaded onto the NZX this morning. We'll try and get through that fairly quickly, and certainly from our perspective, we'd like to spend probably more time talking about what the future opportunities look like rather than looking back. But as I said, we'll try and get through that relatively quickly and leave ourselves plenty of time for you all to ask questions. Now, in terms of asking questions, I'm sure you've all done this many times before. There's actually two ways of being able to do that. One is to use the Q&A function. So if you want to type in your question, we will then monitor that and answer the questions at the end of the presentation. Alternatively, if you're joining by phone or if you'd rather ask questions verbally, then there's the raise hand function. So if you literally just press that button, that will indicate to us that you wish to ask a question verbally, and when the time's right, we'll let you in. So hopefully you've got loads of questions to ask. As I said, we'll spend probably 20-25 minutes going through the presentation and then we'll open it up. So without any further ado, I will just load up the presentation. Hopefully we'll just share a screen. Thank you, Phil. Yep, going from there. So just give ourselves a minute. Technology needs to catch up with us here. Right, excuse us all. Well, we seem to have got a slight glitch here. So while Phil is doing that, I'll just start talking. So really, we'll talk a little bit about FY22 overview. We'll talk primarily in a little bit more detail about our generation performance. Then I'll hand over to Phil, who'll talk about the FY22 financial review. And then there's a bit more of a fulsome section that we've got on introduction to Manawa Energy and some of the opportunities that we've got. So there you go. Hopefully you'll all be able to see the content screen that I just worked through there. So move on. Thanks, Phil. So what you've got there is really just a snapshot of some of our key metrics, most of them financial, but not all of them. In terms of our FY22 performance, and we've described our performance as solid. We're very happy with the performance. So if you look at EBITDA level, 204 million, we're up round about 2% on prior year. But of course, it's similar to this time last year when I presented to you all. We talked about some of the challenges that we had around primarily low inflows and operating in a COVID environment. And again, in FY22, we've had to contend with those two challenges as well. But of course, also, particularly over the last 9 months, we've had a huge amount of work across the organisation in terms of the retail transaction and the separation of the two businesses. When you put those three kind of major aspects together, the fact that we've delivered what we believe is a very solid performance is certainly very pleasing from our perspective. Now, I won't go through any of the other financial results in any more detail at this stage, because as I said earlier, there's a section later and Phil will step you through some of those. In terms of really though, our FY22 summary, and this slide really just provides a bit of an update on some of the highlights of the year. But really what I wanted to draw out from that, and again, remind everybody listening in, is really just the significant increase in the level of activity and investment across our generation portfolio, and we'll come on to that a little bit later. We've talked about our enhancement programme in the past, and that has really ramped up again over the last year. But really, if you look at a year of challenge, as I said earlier, to be able to have both our generation and our retail segments returning results that were ahead of prior year, again, as I said earlier, is very pleasing. And I'll come on to talk about our generation pipeline, which has really significantly accelerated in the second half of the last year later on as well. But it wouldn't be a presentation without, certainly over the last couple of years, without actually talking about the retail sale. But it does give me great pleasure to tell you this will be the last time, the last time we actually talk about this. And look, I say that somewhat bitter, with an element of bittersweetness. I mean, the whole process has gone pretty much as well as we could have hoped. We were delighted, obviously, with the fact that Mercury came in and offered what we believe is a very good price for our business. But equally, we were delighted in being able to hand over a business which is in extremely strong shape. And as I said earlier, from a financial perspective, even exceeded our results from FY21. And at the same time, of all the disruptions that we've had, as you can see in that last bullet point there, we were still able to increase our customers and, of course, our mobile connections over the last year. So a very pleasing result, and it's just great to be able to put what has been a huge effort behind us. But moving on, if we now look at our generation performance in FY22, and first we'll talk a little bit about health, safety and well-being. So as you can see from the graph, the two graphs on the top right-hand side of that slide, it's a little bit disappointing, if I'm being honest. If you look at our lost time injuries, we had 2 LTIs over the last year, where we had 0 for the 2 years prior to that. So while that's disappointing, it is worth noting that both those incidents were of low consequence, and there are no systemic issues highlighted, but it's certainly something that we continue to monitor very carefully. There was actually an awful lot of work from a corporate level that we put into health and safety last year. We undertook a health and safety culture audit, which highlighted a lot of very positive aspects, but as always, you can never be as good as you want to be with respect to health and safety. So there are a couple of 2 or 3 things that have been identified where we will seek to improve in FY23 moving forward. But I think certainly from my perspective, if you look at the 2 bullet points in the bottom left hand of that slide, and referring back to the retail sale, I mean, we knew in announcing the retail sale that would create significant anxiety with the circa 800 people that we had across the organisation. So we put a huge amount of effort into making sure we put in initiatives to actually support our people, particularly over the last 9 months. So it's really pleasing that we have already won an award. The health and safety wellbeing is part of the human resource that's still going. Sorry, my screen just changed, excuse my pause. And we've also just been confirmed as a finalist in the wellbeing category of the New Zealand Energy Excellence Awards, which is to be announced in June. So I think just the recognition of the support that we could put into the well-being of our staff throughout the last year is really pleasing from my perspective. Moving on, and again, as I said, this section is on generation. Looking at the wholesale prices, I'm sure those of you listening in today will look at this almost on a daily basis, so this won't really come as any surprise, but we've had, spot market prices that have continued to have quite material volatility over the last year, and certainly have remained at elevated levels, certainly through the first half of FY22 and then dropped down for the latter half of last year. But certainly since January of this year, we've seen those high prices persisting certainly into Q1 FY23, and we expect that to continue moving forward because we believe that it's pegged to the cost of thermal generation. Now, interestingly enough, this is a really interesting slide here, and I'll bring your attention first of all to the graph on the right-hand side. So what that shows is, as it says, the monthly inflows into all of our catchment schemes around the country. And what is particularly stark is that over the last 4 months, that we have had inflows at somewhere between the 5 and 10 percentile level, which is effectively unheard of, quite frankly. If you actually look at it over the last year, you can actually see that the vast majority of our inflows over the last year were below mean, but particularly, as I said, over the last 4 months, we've had particularly dry conditions across New Zealand, and I'll talk about that a little bit later on. Now, this graph to the right talks about our controlled storage, and when I say controlled storage, I'm primarily talking about our schemes at Waipori, Cobb and Coleridge. So they are the structural levers that we have got to enable dispatch into the market. And so we have done, I believe, a very good job of maintaining reasonably good storage levels in all three of those schemes. But as I said earlier, certainly been a very challenging start to the year. So talk a little bit about some of the work that we've done across our scheme. I made the comment that we've had unprecedented levels of work. At our branch scheme, which is in Marlborough, we are effectively in the throes of recommissioning that. That's been out of commission for the past 3 or 4 months, as we have delivered a quite significant enhancement project to branch, which will double the output of that from 10 up to approximately 20. Up to actually not double it. It will actually deliver 10 additional gigawatt hours per year, and we expect to commission that scheme within the next month. So that's gone incredibly well for us. It's been certainly has been a success to date. In parallel with our Waipori scheme down in Otago, which is one of our most significant and strategic assets. And it actually consists of 4 separate stations that cascades down from Lake Mahinarangi. So we've had planned outage work on that scheme across all 4 stations, encompassing 20 major projects. Now, the main reason for that outage work has been to actually replace the generator in Station 4, which has gone absolutely according to plan. But we also took the opportunity to undertake a lot of preventative maintenance work around our Station 2 as well. But as I said earlier, that's a very, very important storage scheme to us, which has gone very well. Now I'm just going to check. We may just have lost the presentation. So while we load that back up, the next slide that we will talk about before we move on to Phil is our asset enhancement programme. So we've been talking about our asset enhancement programme now for a number of years. And so what this slide shows is that we have already delivered 15 gigawatt hours worth of enhancements, which have already been completed. We expect to complete another 15 gigawatt hours by the end of FY23, of which the branch scheme that I just spoke about will deliver 10, so 3/4 of that additional. But what is of particular note is we have been targeting round about 67 to 69 worth 69 gigawatt hours of enhancements through to FY25-26. As I said, by the end of this year, we'll have delivered 30. But in the process over the last year, we've actually identified a further circa 79 gigawatt hours worth of enhancements that we are currently looking at that could be delivered through to the end of FY26. Now, they're at various stages of progress, and they are obviously incumbent on achieving FID, but we are very hopeful that we'll be able to increase on our original target of 67 gigawatt hours and continue the significant investment that we've got over our generation fleet. So look, I'll come back in a moment to talk about what the future looks like from a Manawa perspective, but I'll hand over to Phil at this stage to dig into a little bit more detail around some of our financial results. Phil.
Thanks, David, and kia ora, everyone. I will just take you through a few summary slides on the FY22 financial performance. Our financial statements at 31 March are a bit different to previous year ends, and the mass market retail business has been accounted for as a discontinued operation and therefore held for sale. And this does impact on the disclosures in both the P&L and balance sheet. However, having said that, if we look at the consolidated FY22 position, we delivered an EBITDA of 204 million, which was a solid result in a year of significant change. And this included 7.3 million of one-off costs relating to the sale of the mass market retail business. If those one-offs were excluded, as you can see, EBITDA would have been 211 million, which is an increase of year on year of approximately 6%. And pleasingly, as David alluded to, both our generation segment and our retail segment we're ahead of the prior year, and I will talk to each of those segments on the following 2 slides. The mass market retail business saw year-on-year growth in EBITDA and in customer numbers, with a 2% increase in total utility accounts and a 5% increase in customers with 2 or more services. As you can see on the bridge, EBITDA was positively impacted by the capitalisation and amortisation of customer acquisition costs, which is what we refer to as IFRS 15. There are 2 components to that year-on-year improvement there, one being the lower amortisation costs that flow through from prior years, which were affected by COVID-19 in terms of the level of acquisition activity that took place. And the second component is just the higher revenue through IFRS 15 due to the higher retail selling prices for the incentives in FY22. Finally, you can see there our one-off retail sale costs are split into 2 parts. The direct costs relating to the sale transaction are reported against our discontinued operations, and you'll see in a moment or 2 that the costs relating to the separation and establishment of Manawa Energy are reported as part of our continuing operations. Continuing operations represents our generation division, as well as our commercial and industrial customers' performance for FY22. The call-outs there on this chart, the positive year-on-year energy margin reflects a 3% higher generation volumes for 22 compared to 21, and higher wholesale selling prices. These are reflected in a GWAP increase, which increased from $144 per megawatt hour in FY21 to $166 per megawatt hour in FY22. The value of our carbon credits also grew in FY22, and that delivered a year-on-year uplift of $5 million. The total carbon credit in FY22 was 8.5, i.e. there was approximately 3.1 million in the prior year. And that was mainly due to unit price, which the unit price of the credits almost doubled over the year, from $37 to $75 at year end. Generation costs were approximately $5 million higher in FY22, and this is due to higher levels of maintenance work at our sites, and also some higher insurance costs, where we've seen a second year of sort of 20% plus increases in insurance premiums. If we look at our CapEx spend at a number of our key generation schemes increased in FY22, and this took our total CapEx for the year up to $46 million. The generation enhancement projects are a key part of our strategy, and as David discussed earlier, they generally have very good rates of return, with almost all of the standalone enhancement projects showing internal rates of return in excess of 10%. The capital spend on these enhancements, as well as the key life cycle maintenance events and the start of our new generation pipeline, will mean that our CapEx remains at this higher level in the near term, before normalising back to closer to historic levels beyond the near term. And I should also note that this level of CapEx obviously doesn't include any significant large new development projects, which will be over and above. It does include some very early stage sort of, land acquisition and costs around new development. In terms of the balance sheet and in particular the debt position, our total net debt at 31 March was $715 million. And following the sale of the retail business and payment of the special dividend, net debt will fall to approximately $430 million. And we'll have a circa $300 million of unused bank facilities, so we will repay a portion of the facilities that mature in July of this year. And as we noted in our 13 April update, we have reviewed our capital structure with a view to carefully balancing the need to preserve capital to fund new generation while also maintaining an appropriate dividend policy. Our Manawa 150 bond matures in December this year, and we are planning to refinance with another similar bond issue. This will position us with a solid balance sheet as we start to implement the new strategy. As previously indicated in the April update, the board have now declared a final FY22 ordinary dividend of 16 cents per share and an unimputed special dividend of 35 cents per share. These will be paid in mid-June. I'll now hand back to David to present the go-forward Manawa structure and strategy.
Thanks, Phil. You can probably just go on to the next slide. So as I said, we've just got a few slides left now, probably another 5 to 10 minutes, and then we'll throw it open for questions. So really just an introduction to Manawa Energy, and really to reiterate some of the messages that we've probably had out there and hopefully you're now well aware of. But our core focus now moving forward is on the growth through the development of new renewable generation assets, primarily wind and solar, as well as optimising and enhancing our existing generation assets, which, as you've just heard over the last 10-15 minutes, we've been on a path of doing over the last 3 or 4 years. So really just kind of some stats to remind everybody. Manawa Energy consists of 25 hydro schemes with geographic spread across New Zealand, and it's just worth pointing out there that also includes 5 King Country Energy, KCE hydro schemes, where we own 75% of those schemes. We've got approximately 680 commercial and industrial customers, round about 240 full-time employees, and now have a dedicated new generation development team. Now, in terms of our board of directors, we had a few changes over the last financial year. So just want to acknowledge 3 previous directors, Susan Peterson, Keith Turner, and David Gibson, who all stepped off the board over the last financial year. As I said, I'd like to thank them for all the support that they provided to us, but also like to welcome on board, and I think we're very lucky to have John Briar and Sheridan Broadbent now on the board, who bring some fantastic operational and strategic experience from the energy and electricity sectors. So it's great to welcome those on board, and also Michael Smith, who joins us as a nominee from Tech, who brings some significant governing experience as well. In terms of the leadership team, I think we're very lucky. Obviously, you've heard from Phil, who's a relatively new GM Corporate Services. Phil started on the 1st of February. Seems like a long time ago, Phil, yeah? The 1st of February this year, and comes with many years of CFO experience over a number of different sectors and industries. I'm sure many of you out there will know Catherine Thompson. Catherine was at Contact for, I think, approximately 11 years before joining us, and she has deep knowledge and deep experience of the electricity sector. So she's been a wonderful addition to the team. And of course, I'm also guessing that many of you know Rob Buchanan, who for the last 11 years has been with Forsyth Bar, and over that time period has been involved in many major transactions and acquisitions particularly in the energy sector over that time. So it's great to have that new capability on board, of course, supplementing Stephen Fraser, who's General Manager Generation, and Matt Van de Venter's General Manager in Technology and Delivery. So it's a pretty, I think, exciting team to help lead us forward. So in terms of moving forward, look, the strategic context is really just, again, a repeat of many messages you'll have heard from us in the past, and that is one of the central tenets of the retail review in the first place was a belief that the New Zealand economy is expected to continue to decarbonise, which means that the demand for electricity is expected to grow by 50% over the next 20 years. And I think The announcement that's coming out from the Prime Minister today, or Minister Woods and Minister Shaw, I think will be fascinating. And of course, that's on the emissions reduction plan. And after 4 long years of talking about the what and talking about the targets, I'm really, really interested to hear from them today as to what the how looks like. How is it we will actually going to get there? And I think once we actually get some tangible commentary around that, I think it will be certainly from my perspective, very exciting from our perspective, and how we as an organisation can play our part in, as I said, helping to decarbonise New Zealand moving forward. So, in terms of our strategic plan, as I said earlier, it's fundamentally based on growth, okay? And that growth will come through 3 or 4 different channels. First of all, we are looking to grow new development opportunities, and we'll come on to that in a minute. We are also looking to grow our C&I customer base, both in terms of new customers, but also offering new products to existing customers. So kind of 2 different paths to market that we're exploring with our existing customers at present. And then finally, as I've talked about, in terms of operational enhancement and actually doing what we do even better than we're doing it just now, and actually enhancing the portfolio that we've got. But as I said, it's all fundamentally on growing our capability, growing our capacity, so that we can support, as I said earlier, the decarbonisation efforts of New Zealand. So what does that look like to us? Well, as you know, as I've said earlier, we're taking a very flexible approach to new developments. We're not just pursuing our own projects, but we're looking to do that in partnerships and joint ventures with other existing developers and partners out there. Our existing assets means that we are well placed to take development concepts through to execution. And of course, we believe it makes us a very attractive partner to both developers and end users. And I expect I will get asked this question, so I'll front foot the question, and that is, it seems to be almost on a weekly basis at present that will be some new generation scheme that is announced, which is super exciting. So how are we different? Well, when I think about how we are different, how we position ourselves to be different, there's probably five key aspects that we have an advantage over many of our competitors out there. First thing is our trading book capability, which we've talked about on that previous slide. The second one is on our customer proposition and the options for path to market and the ability to offer a package of firmed renewable generation. So that's growing new development, whether it's solar or whether it's wind, but supplementing our existing hydro schemes to be able to offer a package of firm renewable generation. The third thing is we already have strong development capability. We've been here before, we've retained that capability. The fourth, and especially now with the proceeds of the sale, we have access to capital and the ability to fund those opportunities moving forward. And the fifth thing is, because of our geographic footprint, we have existing strong relationships with potential partners around the country. So with those 5 things, I believe that sets us apart from many of our other competitors out there at present. But what we are seeing is just, as Rob Buchanan has said, the trickle has turned into a fire hose, just in terms of the opportunities that we've been able to identify, particularly over the last 6 months. And I won't go through every single bullet point there, but I think really the key thing is that we have currently got over 30 new solar and wind developments at various stages of progress, but 4 solar projects in the feasibility stage. We've obviously announced one, which was a joint venture partnership with Hawke's Airport in respect of a 24 megawatt solar farm there. We're not in a position to announce any more yet, but we certainly hope to do that in the coming months. But I think the key point for everybody to note is that, just as I said earlier, the material uptick in opportunities and people wanting to talk to us about partnering on those opportunities, which is really exciting. I'll maybe speed up here, to be honest. I think we've been talking a little bit. I've talked a little bit about this before. This is one of the key tenets of our strategy in terms of portfolio management and in terms of our path to market. But one of the key reasons for putting that up there is that you'll all be aware that with the long-term hedge with Mercury, that's going to provide us revenue certainty for the near term, certainly through to the end of FY25 or near the end of FY25, while providing increased freedom beyond that to develop a balanced sales portfolio over time. And as this declines, we'll create revenue certainty through developing those long-term relationships with potential partners and new partners and new products that we are investigating and developing right now. And we will keep the market updated as we do that. Second last slide for me, in terms of capability to deliver, and really this is just a summary. As I've said, we've been here before. We've pioneered wind development in New Zealand and Australia, of course, including Tararua and Mahinerangi projects in New Zealand and Snowtown in Australia. In addition, we have supportive, experienced majority shareholder, a leadership team with significant relevant experience, significant and flexible funding capability, strong existing relationships, and a diverse portfolio that allows us to present and offer firmed renewable generation to both our partners and our customers going forward. But of course, all of this is reliant on us operating. So next slide, Phil. All of this relies on us operating within an aligned regulatory environment. And again, I won't go through this in detail, but what this does is it gives you an update on the status of some key matters at play, both from a regulatory perspective or policy perspective and Manawa Energy's view on that. But certainly from my own personal perspective, the number one, certainly important piece of work that I'd like to see get some clarity on is this the national energy strategy, because unless we have an energy strategy that considers all three pillars of the energy trilemma and fundamentally puts prioritising of decarbonisation front and foremost, then we are going to continue to have other regulatory issues and other policy decisions that are made that will create uncertainty going forward. So certainly from a Manawa perspective, we will be advocating very strongly to have a properly balanced national energy strategy moving forward. So that's probably enough for me. I'll hand over to Phil to talk a little bit about outlook and guidance, and then we'll open up for questions. Thank you.
Thanks, David. I've just got 2 or 3 slides in terms of sort of forward-looking financials. Perhaps I'll start with the very short term, and in terms of we have experienced very dry conditions for the past 3 months, and including the first 6 weeks of FY23. We combined with low wind, this has impacted our trading at the start of FY23. Our hydro, for example, our hydro inflows for the first half of May are approximately 30% below average. Now, it's far too early to draw any conclusions, and those who've been in the industry a lot longer than I have know that hydrological and wind conditions can change very quickly. But we are, watching the forecasts for a return to more normal sort of autumn, winter weather conditions. Looking further ahead, we are very positive about the new generation pipeline and the earnings growth that could be delivered in the medium term from that pipeline. In the near term, as I referred to earlier, capital expenditure will remain elevated, and we will plan for this investment as we move into the refinancing of our bank facilities and the maturing of the bond later this year. Finally, we reiterate here the guidance we provided in our 13th April update. EBITDA guidance being in the range 140 million to 160 million, and CapEx in the range of 45 million to 55 million. So just to wrap up, look, thank you very much for taking the time today to tune in to this webinar. And we very much look forward to many more of these as Manawa Energy starts an exciting new journey. And with that, I think we've got a few questions in Q&A that I'll stop sharing and we can go to those questions.
Perfect. And you'll be glad to know, Phil, that probably the first two questions are for you.
Fantastic.
So I've got them there.
The first question, you gave DPS guidance at your special meeting last year. However, since then, the special DPS was below market expectations, and today's ordinary second half dividend is 1% per share below first half dividend. Can you give us any colour on whether or not you have changed your thinking on the Manawa ordinary dividend going forward? Look, we have spent quite a lot of time with our board looking at capital structure and carefully balancing the need to preserve capital and to maintain an appropriate level of dividend. We are going to constantly review that, but it does very much depend on what we see come through the pipeline, of new generation pipeline in terms of scale and timing. And while we will also be looking very carefully at, I guess, funding structures that we use for the larger generation projects, and they won't necessarily all be funded off the traditional facilities that we currently have. So look, that's a roundabout way of saying we are committed to maintaining an appropriate dividend level, but it is also contingent on just the pipeline of generation and what the needs are in terms of capital for that.
No. Which I guess is a good problem to have.
Really good problem to have. Yeah. Second question: in your FY23 EBITDA guidance range, how much is from the retail business to 1 May? Yep. So we have, I think, called out in our guidance that it does include retail earnings for 1 month, and that's in the range of sort of 3 to 4 million of earnings that we'll see from that retail business for that 1 month stub period.
Great. So we've got no open questions at present. Oh, sorry, we've got 2 hands up. So how do we need to let them in? Sorry. Sorry, we're just working this out. Sorry about that. Who put the hands up, Carl? Andrew and Grant. So we're just Andrew and Grant. We're trying to let you in, but we've got some technical challenges. If anybody else is, in the meantime, if anybody else had a question that they wanted to type, or Andrew and Grant, or Grant.
I think I'm unmuted now.
Grant online. Grant?
Can you hear me, David?
Yes, I can, Grant. Hi, how are you?
Good on you. Congratulations on a maiden Manawa update. Firstly,
Thanks,
just in terms of your guidance, a midpoint of 150. Can you just talk through some of the flow chart on how this 164 number, I know there's about 5 million of carbon excess in there, but then you're adding back 3 or 4 million for retail, and then you've got about 155 gigawatt hours of extra hydro in your year. Why are we so far down on the PCP?
Perfect. Grant, again, I'll hand over to Phil to answer that. We're perhaps anticipating this question.
Thanks, Grant. Just bear with me for one moment. A couple of things to take into account when you're trying to sort of do a high level reconciliation of that. One is this top one outage that we are experiencing in FY23. So that in our guidance, we've got the impact of that outage continuing. That's sort of in the sort of 5 to 7 million range of impact. We've got the carbon that we've impact that we've seen in FY22 that won't, we're not forecasting to recur in FY23. So that's 8.5 million. Probably the two other elements I'd call out is the bridge on FY22 EBITDA is based on a overhead structure, an allocated overhead structure, where the total trust power overheads in the old business were allocated between retail and generation. Obviously, when you split the business and create this new Manawa entity, the overhead structure will be slightly different to that. So that is impacting. And then there's also a modest impact from the Mercury hedge, where that's at a slightly lower price than the previous internal hedge to the retail business. So those are probably the four factors you need to have a look at on that.
Okay, thanks. And then a follow-on question, just in terms of, so you guys had given guidance of an average hydro a year of about 2,000 gigawatt hours of generation. Can we think of it as 230 by the end of this year with the extra 30 that you guys are adding to it?
No, we've actually provided some guidance there on that, Grant, right at the back of the pack.
My apologies.
No problem. I just can't find the slide, but it's about just over 1,900.
1,915 gigawatt hours is what we've got in our 23 guidance.
No, that's 1915 as a guidance for 23. I'm talking about what is normalized. Obviously, you're starting the year on a much lower ebb. So what is normalized?
So I think your question is, our long run average, if you adjust for enhancements, is probably around 1,942, right?
Okay, thank you. That's the number I'm looking for.
Yeah.
And then your debt to EBITDA ratio, I know you guys have a slightly different structure in terms of your credit metrics and not really having any compared to the other gentailers. But you guys are already on your midpoint guidance of this year, pushing above 3 times. What is your parent comfortable with?
Yeah, as we said in our update when we went through the capital structure, and we said we would be targeting that sort of 3 to 3.5 with the ability to go to 4 to fund over and above growth, and certainly the parent has indicated they are comfortable with those levels.
And then final question, thank you for that. You talk about non-debt financing. What are you referring to? We're not talking about an equity raise, are we? Is this just hybrid debt, maybe?
Yes, or joint ventures, project-specific financing structures. That's what I had in mind.
Yeah.
Thanks so much for those answers.
Thanks, Grant. Sorry, we've got Andrew. Yep, we'll do Andrew, then we've got a couple of questions that have come through. Hi, Andrew.
Hi there, hopefully you can hear me okay.
Yeah, we can. Yep.
Great, thanks. So a couple of questions from me. I guess it's just sort of thinking about the development pipeline you've got, and I guess the sort of the cadence you expect to go at going forward. Just trying to get a sense, I guess, of what sort of capex, growth capex level you might be thinking about, I guess, in a couple of years' time and into the foreseeable future.
I'll talk about why. Yeah.
It's a good question, Andrew, and it's one because the pipeline is relatively early stages, and we don't know which of the projects will crystallise. It is hard to put a forecast together for the next 5 years on growth development capex, because it very much depends on whether we're doing 20 megawatt projects or 150 megawatt projects. I'm not sure that I can probably answer more specifically than that.
No, not really. Not really. I can't really add anything to that other than just to kind of really reiterate that comment I made in one of the earlier slides. The fact that we've got north of 30 current opportunities at various stages, really just as an indication of the level of activity. But I mean, it shouldn't take a rocket scientist to know that it will only be a relatively small percentage of those projects that will actually eventually get through FID. So really, as Phil said earlier, we're trying to maintain through our balance sheet structure, we are seeking to get the right balance between returning what we believe is an appropriate amount back to our shareholders, but at the same time maintaining enough balance sheet flexibility to actually fund projects which could be anywhere from 10 to 20 million all the way up to 150 million. So Andrew hasn't really answered your question, but yeah, I'm not sure we can provide any further kind of context than that.
That's all good. That's some useful colour. And I guess the other sort of slightly related question, I mean, you talk about sort of one of your key advantages you see is the ability to firm some of these projects and provide firmed energy to, I guess, predominantly the commercial industrial customers and maybe some other retailers. What sort of capacity of guess new solar wind projects could you actually do before you think you might run out of your firming capacity, as it were? There are limits, I would have thought, to how much you can build before you start running out of hydroflex.
Yeah, Andrew. I mean, one of the benefits when we look at that is we have the Mercury hedge does start stepping down from sort of late 2025. Yeah. So that frees up some volume that we can use to firm or potentially do other things with it.
So it steps down, and I'm looking over at the chaps on my left here to make sure I say the right thing, but it steps down approximately 200 per year from FY25, roughly. So we decided, so it's roughly 200 a year from the end of FY25 onwards. So that gives you an idea about that additional capacity that we'll then have to firm.
Yeah, okay. And last question, I guess, is actually just around the judicial review and whether you've got any sense on timing on that decision. It's been 7 months or something, I think, since the hearing.
No. We haven't heard any. Have you heard anything, Andrew? No, we haven't heard anything. So I don't know if there's anything you can necessarily read into that, but we're certainly waiting with bated breath on that. But as you're aware, all our forecasts moving forward certainly assumes that we will be unsuccessful in that. So anything more positive than that will be an upside.
Yeah. That's all good. That's all from me. Thanks.
Thanks, Andrew. So there's two or three questions, a couple from Stephen, but I think we've actually, Stephen Hudson, sorry, that have come through, who also asked about the judicial review, so we've just answered that. Stephen also was asking about top one impact, but I think Phil answered the top one impact earlier. But Stephen has also asked, how many months of the Mercury CFD CPI indexation are there in FY23? So on the CFD that we have signed up with Mercury, that indexes to CPI in October of every year. So that means that for this financial year, we will have 6 months of indexing to whatever the CPI is at that stage. So 6 months in this year. Oh, sorry, I've just seen, so hopefully that answers your question, Stephen. Another one in from Jeremy. What is the approximate size of Northland solar development? And again, Jeremy, that is unfortunately confidential. We're bound by confidentiality, so we're kind of unable to, much as I would love to, and we certainly will in due course. At this stage, unable to talk about that in any more detail. So, apologies. So we're close to the end. We're at 10 to 12. I think if there are no more questions, and I'm kind of pausing to see if any come through, it doesn't look as if there are, we might just call that a day. So thank you all very much for listening in to what has been very exciting, certainly from our perspective, to be able to present the first annual results as Manawa Energy, and we look forward to many more moving forward. So thank you, everyone, and for those that we're seeing tomorrow, we look forward to catching up face to face. Thanks for now. Kia ora.